7 years ago, Berkshire Hathaway CEO Warren Buffett placed a private wager with Protégé Partners, a New York money manager, that his investment in an ETF that tracks the S&P 500 index could beat the return from a bunch of hedge funds over the period of a decade. With 3 years to go, Buffett is handily beating Protégé by more than a 3-to-1 margin. So is active stock picking by a hands-on manager really a waste of money? David Kaufman, CEO of Westcourt Capital, is here to help answer that. Here's the question: when can active management beat the passive investment approach? And I guess we should note you've got skin in this game because you're an active money manager, so it's not as though you don't have a point of view on it.
Well, we don't actively manage money in-house, but we do select active money managers.
Right.
And that question comes up all the time, is that you have sort of one side of the investing world that says invest cheaply in the market and buy ETFs, and that way over time the market tends to go up and that you'll go up with it, and you won't have to pay the higher fees that active managers charge. And on the other side, there are people that say no, over time the great stock pickers will beat the index because they don't have to invest in companies that are of lower quality. The data show, unfortunately for the active managers, especially the broadly diversified active managers,
right,
that net of their fees, that they tend to pretty much provide you the market over time, which is why, from our point of view, the best way that an active manager can beat the market, in fact, maybe the only way over an extended period of time, would be to be very concentrated. And there's not a better,
which is risky, right?
It can be risky because, of course, you increase the likelihood of a big win, but you also increase the likelihood of a big loss.
So one of the things that has always struck me about this conversation is that obviously when you do passive, so I buy indexes mostly, that's how I invest. So you buy the index of a bunch of different markets, it's very low fee, you're going to track the market. I assume that over the long term, between now and my retirement, I'm going to get 7 to 8% a year, and that's it, because that's what markets return over the long term. I can live with that. But every now and then you see a story or you see the returns for a money manager, and they're great and they've done a really good job, and you think, if only I'd known that 5 years ago and given him my money. Is he going to do it in the next 5 years, or she? Do the really strong performers, is my question, tend to outperform over the long for 40 years, or is it 5 years here, 5 years there?
That's the question, is that if you want to measure the persistence of returns, so does one 5-year top quartile manager necessarily mean that they're going to be in the top quartile again? The best example of someone that's done it over the long term, ironically, from the lead, is Warren Buffett himself.
Right, yeah.
I pulled off today that from 95 to 2005, which is before they started the bet, Berkshire Hathaway beat the S&P 500 total return by 117%.
Right.
In the 10 years since 2005 to today, they've beaten the S&P 500 by 35%. So that doesn't necessarily prove that he's the greatest stock picker of all time, but it does, lead one to think that if you are concentrated and if you buy companies, if you use a fundamental analysis that is sound and you buy deep value companies, that over time you can beat the market. And that to some degree makes a lot of sense, because you don't have to own the resource stocks, for example, or the telecom stocks.
Although if you buy an index that's the Canadian market, you're owning telecom, retail, and banking.
That is true, but if you want to be
if
you want to be a little more conservative than that, you can also buy ETFs that track, for example, just industrials, just financials, and you don't have to buy resources.
So back to Buffett and this bet for a second here. He wasn't really betting against active management in the sense that, I have a financial advisor who will tell me to do things, and there will be some things that aren't just an index fund. He was betting against hedge funds, 2 and 20, huge fees. We now consider sort of 2.5% to be a big fee. When you look at Berkshire's returns over the long term, if he was paid the way a hedge fund manager has paid, the returns dwindle to, it still looks good, but compared to what you get just by owning the stock over that same time, they dwindle to nothing. So let's talk about that for a second. It won't apply to very many people. Most of us can't afford, we don't qualify for hedge funds anyway, but if you do, is 2 and 20 a bad model? Is that going to change?
That's an excellent question. So the way we look at it is that the fee structure is a value proposition. In itself, 2 and 20 is not necessarily good or bad. It's after fee returns that matter. There are funds out there that net of their 2 and 20 fees, if that's what they charge, over long periods of time, 10, 20, 30 years, have indeed provided positive returns net of everything over time, and many of them didn't even lose money in 2008. Unfortunately for the group of hedge funds that were in the basket that was bet against Berkshire Hathaway, or sorry, against the S&P 500, they were probably much more directional hedge funds that were making bets on things like gold or housing. Sometimes you have big wins, but boy, you can have big losses, especially in 2008.
I want to get to our second subject, but just quickly here, because this is something that you do you do deal with, and that is the alternative space.
Yes.
Is there a case to be made for paying a higher fee for engaging somebody to get something you can't otherwise get? Maybe that sounds like an obvious thing to say, but sometimes in order to get an alternative investment, there is no index of that, so you actually do have to seek it out. Is it worthwhile?
Yes. And
again, with all your self-interest sort of fully stated.
Fully. Again, it's a net of fee question. And so there are strategies and then there are businesses. And sometimes you're investing in, let's say, a REIT. Which is a real estate investment trust. A REIT is a business. It's buying a group of real estate assets, managing them well, collecting the rent, taking your management fee, and then paying out the rest to the investors.
Right.
That is it's easy to understand, but that is very difficult to execute. And so those managers demand and deserve a higher fee. In other cases, of course, the proof is in the pudding. That if you have a strategy of liquid assets and over time, the 2 and 20, it takes all of the value out of it, and what you're left with is returns that you could have had very cheaply, well, then there's no value at all.
I want to get to our second question here. Interest rates are low, obviously. Bond investors are turning to higher and higher yield bonds as a way to earn interest. There are pitfalls here when investing in what you would call junk bonds. So our second question asks, what should investors be wary of when investing in high yield bonds? And this is actually something, a lot of people, and I'm thinking here seniors on fixed income, have been migrating up the risk chain and down the, up the balance sheet, right. Or down the balance sheet anyway, to the riskier parts of the balance sheet. What are the pitfalls here?
The main pitfall is that a company that issues a high yield bond, obviously, if they could issue an investment grade bond, they would. Right. It means that that company may be doing just fine, but they have a balance sheet which maybe has more leverage on it. Maybe they have less certain returns over time, which means the market commands a higher return from them to lend them money over time. The issue is that when times are good, high-yield bonds are a great investment because they might pay you 5 or 6%, which is a lot more than the 2 or 3 you're going to get by investing, say, with Rogers or someone like that, investment grade. The downside is that if there's a downturn in the market, and yes, interest rates might go down, in which case many bonds will go up in value. We can talk about that at length. What happens, though, if there's a downturn in the market is that the viability of those companies, I'm not going to say they're going to go bankrupt, but they're slightly in question, which means, without getting overly technical, that the spread on those, the corporate spread between the risk-free rate and what they pay, can expand, which is another way of saying they go down in value.
Right, and their own borrowing costs go up, so if their balance sheet is dependent on borrowing, it actually could put the company even deeper in jeopardy from the point of view of how risky it is.
We actually refer to them in our shop as low beta equities, that they kind of act like equities, but you're much higher in the stack than the equities, which means that you're more likely to get your money back, but there's always that chance that the company, this could be the fatal blow to the company and you won't get your money back.
All right. Great to have you with us, David.
It's good to be here.
David Kaufman, President and CEO, Westcourt Capital.